this is the Chinese Year of the Tiger, and so basically I'll be looking at trends in prices, costs, financings, and exploration. So let's go. So last year, what we saw was almost a bit of a dichotomy between two economies working side by side. So the carbon economy that we're currently in did actually quite well. Coal prices were actually, but I don't have them up here, but they did quite well. Oil did well, natural gas did well, but also those metals that we consider to be part of the future to reduce greenhouse gas emissions, specifically for the electric vehicles, did well. Tin was the best performer, but we saw great performances from copper and nickel, and also in the uranium sector because of a bit of a squeeze on the spot market by the development of some physical trust funds that helped uranium and did a real boon for uranium equities. Lithium carbonate, lithium hydroxide prices definitely helped lithium equities, and the S&P 500 continued to break new records. Palladium, because we had a chip shortage and converters, but we hope to see that correct itself in 2022. But precious metals didn't fare so well as investors were looking for an increase in interest rates and presumably real rates rising. So moving on, Bitcoin, in terms of the group of assets that you saw that I was following for my subscribers on a weekly basis, Bitcoin was the second best performing asset class. And it outperformed gold by quite a bit, but it's come down. And the issue has been with Bitcoin and gold is Bitcoin eating gold's lunch here. And I still think that there's probably a definite diversion between the two investment groups. I don't see a lot of Bitcoin people moving wholly into gold, and I don't see a lot of gold bugs moving wholly into cryptocurrencies. There's definitely probably a generational divide there. And then going forward, if gold attracts new investors, it might have to eventually try to attract some of them away from the cryptocurrencies. But right now, that phenomenon is evident and it's real. But underlying it is it's much more volatile than gold. So another thing that we thought might drive the market more is the COVID pandemic. I mean, when it initially came about into North America in March 2020, we saw a significant spike in market volatility, which drove down most asset classes except for probably the US dollar. And then with every subsequent wave, the trend in volatility as taken by the CBOE volatility index or the VIX has been trending down. So the actual daily cases right now with Omicron in the US are higher than any wave that's been around since March 2020. But the market's really not impacted. The market gets impacted when the COVID cases impact economic growth, supply chain disruptions, labor productivity, which leads to inflation or other factors that drives market volatility, and then we're impacted. But the cases, if they don't impact those variables, have no impact on the market right now. So speaking about inflation, this is a thematic that we've seen growing in 2021 and definitely over the latter part of the year. And it's driven by no single thematic. We've got an increase in goods and services. We've got an increase in energy. We've got an increase in food. So the core to the other rates, they're all high. And so we've hit 7% in the US just recently. And so that's part of the commodity price increases that I talked about before are driving this. Part of the impacts from COVID on labor rates is driving that. Supply chain disruptions, that's all driving this. And so it's not just the US. And so we see, US rates going up to 7%, Euro area is 4 to 5%. China, if you believe the numbers, are around 2 to 3%. And even Japan, which has been historically deflationary, has seen some positive movement in prices. This is what could impact the markets and maybe base metal prices, is if these impacts of inflation have knock-on impacts on global growth, especially in China, which is a major consumer of metals. So Goldman Sachs lowered its projections for China from, I believe, just under 5% to 4.3%. The median right now for 2022 growth in China is 5.2. Any number below 5% is a number lower than the pre-pandemic growth in China. So that's something we got to watch. So the link between real rates and gold price is, but it's not the absolute rate that's important. So as you can see, in August 2021, rates got the lowest that in these 2 years I've been following it, down to minus 1.2%. But it's really the trend that's important, is this big plunge here in May to about July, August 2020 is what drove the gold price up to the record levels over 2000. So it's those spikes, the steepness of that curve, which drives sentiment, which drives the gold price. It's not the absolute number of real rates, because basically real rates have been negative for most of the last 2 years. But now, because those real rates are fluctuating, gold price is fluctuating, and it's sort of almost rudderless right now between 1750 and almost 1900. So we see that reflected in the ETFs. So in terms of the ETF movements, followed on a quarterly basis by the World Gold Council, when we saw gold price go up, and these are quarterly average gold prices, so they're not the daily prices, so you might not see the peaks that we talk about, but from 2010 to 2013, when we saw the movement in gold price up to about 1960, its previous high, we saw 30 million ounces added in terms of to the ETFs, which helps support a 55% increase in gold price. From about that time at the end of 2012 to the beginning of 2016, around there, we saw a net reduction of 38 million ounces of gold from these ETFs withdrawals, and that supported or pushed down gold price by about 35%. But from 2016 until recently, which would probably be Q3 20, the third quarter of last year, we saw 75 million ounces roughly added to ETFs. That supported a 70% increase in the gold price. But recently, we've seen some net withdrawals, about 90 million ounces over the past 12 months, generating a 6% drop in gold price. So that trend is something we got to watch in terms of the gold price. So not only is inflation, potentially impacting real rates, which potentially impact the prices of gold and potentially silver, it's also got an impact on everything. So we've seen capital cost escalation, and so there's a risk for development projects that I hope to bring up with the development projects that we have presenting today. But the highlight or the poster child for this would have been Argonaut Gold. They had a 56% increase in their upfront capital estimate to build the Magino Gold project in Northern Ontario. So that equated to about $290 million. And that resulted in basically in the resignation of their CEO and founder. So about a third of this increase of $290 million was basically put at the feet of cost inflation and the impacts of COVID-19, potentially on labor and the availability of labor and productivity. Scope changes, like they're going to do site power because they didn't have time to do a permit to get grid power, and the tailings accounted for almost another third. Any of the reductions that we would have seen, most of those didn't impact the life of mine capital. They were just deferred and pushed back to sustaining capital. So this is a constant juggle with development projects, keeping it on time or on budget. The budget's been blown. So right now, all they're trying to promise the market is that they're going to try and get this thing to first pour on time. So it's not only capital costs, we're seeing it in operating costs as well. So these lines here, I'm just going to explain these. These are gross margins. So revenue minus netting out the cost of those sales to get you that revenue. So that's your gross margin. It's not taking into account any capital. So what the yellow lines are basically precious metal producers, and the gray lines are base metal producers. Could be copper, could be nickel, could be zinc. So if we look, the margins for gold companies in the latter part of Q4 20 were over 50%. At the Q3 21, and I'll be interested to see what the Q4 numbers are once the companies start reporting, are closer to 45%. So we're seeing basically a plunge in margins on an average basis of these companies. On the other hand, average base metal gross margins that were about, in terms of the companies that I followed here, were down to about 35% in Q4 20. But the rise in the prices of the commodities that they're producing has managed to mitigate or more than offset the cost escalation that they're seeing, such that their margins have actually risen to about 40%. And what's driving a lot of what these prices are doing, like for copper, for nickel, for lithium, and other metals that are related to this electrical vehicle phenomenon, is that electrical vehicle demand, or the forecast for demand, which is driving sentiment and driving these prices. So 78 million cars were basically manufactured in 2020, and it peaked over 90 a couple of years before that. But basically, if we look at that suggests a 50% penetration of electric vehicles in 2032, up to 75% in 2040. And so is this what's going to happen? Because basically that's what's driving sentiment for these metals and driving people to get more of these projects in their pipelines. So if we look at nickel sulfides, that's something where forecasters are basically projecting a supply gap now that's just going to widen, assuming that the demand stays the same. But note that this demand is actually smelter capacity. And so smelters need nickel concentrate, so they're going to demand it. The price is the treatment charges and refining charges, but they need they need feed, they need concentrate. But what's happening now is some of these nickel development projects are looking to get around the smelters by going right to a precursor battery product. That's what's happening with Blackstone Minerals, which I own shares of, and I've owned for a couple of years. And they're trying to get around going to a smelter and produce a precursor battery product right there in Vietnam. The deal that was just signed with Tesla and a company building a project in Minnesota, the Tamarack nickel project, underground nickel project, is basically Tesla's asking for the concentrate. They're not putting up any money up front. There's no financial obligation here, but they're sort of semi-committing that if these guys get this stuff into production, that they'll take 60% of the production of the concentrate. But they're not sending it to a smelter. What they're trying to do is go straight into their battery manufacturing with the copper concentrate. So this smelter capacity in terms of demand, that might change as technology changes going forward, specifically for those people that want the nickel for batteries for cars. Okay, in terms of copper, the supply gap is further out because there is a lot of brownfield expansions happening that might push the gap out to about 2027. But the risk of that brownfield expansion is a lot of these brownfield expansions are happening in the two major producers of copper, which are Peru and that shouldn't say Argentina, that should say Peru and Chile. And so some of these companies are basically holding back major investments, waiting to see how these left of center regimes are going to handle taxes, and things going forward. So there's risk that this gap might come sooner as well. But basically, in terms of permitting development timelines, if we don't know or recognize that project right now, there's very little probability it's going to hit that gap in 2026. So this is what we've seen in terms of since the end of 2019 to now, in terms of an indexed copper, nickel, zinc, uh, um, and lead prices since the end of 19. And so we saw the COVID-19 impact on prices. And then ever since that, it's been growing. Copper outperformed for a while, but now nickel has come back, as have zinc. And so all three of those are up almost 50%, since the end of 2019. But the risk here, and that's what the industry is seeing, is permitting, changing political landscape. All that is coming into effect in terms of copper production, and I'll speak to this later. But just recently we had this issue with Cobre Panama, and Panama asking for higher rents from that mine right now before they will let them keep operating under the contract that they'd signed. And so that sort of creeping nationalism might be an issue as these prices rise. So that's something else we got to watch. So in terms of what we saw last year, we saw a significant increase in financing specifically for juniors and intermediates. And so we saw an 86% hike in prices. So last year it was 28% versus the year before, but now it's like 86% higher. Most of that, base metals and gold, both of them were both up about a third. Specialty commodities increased the most, about 160% up on the year before. That's your lithium and all these other specialty metals that smaller markets right now. But what we did see is a drop in the number of transactions, such that the average equity raised was higher at about $8.5 million in 2021. So all this money generated exploration expenditures. So exploration expenditures were up about 35% in 2021 to over 11 billion. Primarily the driver was juniors, driven by the backdrop of those financings. So 1,605 companies raised about $4.1 billion. Not raised, but spent that much money. So the average expenditure by these companies was $2 to $3 million. But interestingly, like these non-cash flowing microcaps managed about 37% of the 2021 global exploration expenditures. Are we going to see that going forward? That's the question. Okay, so this is a colorful graphic, but what it's telling you is the first column going down the totals is telling you that the three most important jurisdictions where the money went was Canada, Australia, and the US. So that's 64%, almost 2/3 of all the money went there. Okay, after that, you got Mexico and Ecuador, Argentina, but a significant drop off after Canada and Australia and the US. And then if you look at 59% of all the exploration expenditures went into gold. Gold was the primary, followed by base metals at about 20%, and then a bit of a drop off as we go forward. If the real rates continue to be challenging, gold price, then the sentiment might be negative towards gold, and so we might see less financing for gold. The question is whether base metal investors will take up the slack, or will we just see gold financings decline? Another interesting point is because potentially of the issues with Peru and now with Chile, Ecuador and Argentina actually, and even the DR Congo, exceeded exploration expenditures in Peru and Chile. So we're seeing the exploration money move to different places. Okay, gold M&A. These are just transactions I followed, 16.5 billion transactions worth of transactions I followed, basically changed ownership of about 65 million ounces, global resource measured, indicated, inferred, on operating assets. That was the focus, with no development risk. The average acquisition cost was like $234 per ounce, but ranged from $40 to $389 an ounce. The big exception here was the purchase of Great Bear for Dixie Lake. That exploration company had no resource. I expect more consolidation, basically, to gain scale and relevance. Okay, base metal M&A. We saw copper and nickel, 4.8 billion in copper, 1 billion in nickel. And you could look at the transactions here, but these transactions, some of these sellers were private equity firms and Asian firms that as an investor, we wouldn't have had exposure to. But there's definitely consolidation here and trying to get operating assets into portfolios here. And so where do you want to look? Like if we look at Trilogy and that, they fall into that square of lower capital intensity and high IRR projects. Those are the ones that we should be looking at with respect to what companies might want. It's harder for companies with a market cap of 30 or 40 million, but with a upfront development capital of 1.5 billion to do much in this environment. But, we did see Jose Maria taken out by Lundin Mining, but that almost seems like a consolidation of family interests by the Lundin Group. Okay, and then overlying all this is all this geopolitical and permitting risk. And I mentioned that recent issue with Panama. We've got, Rio Tinto in Serbia. We've got issues with lithium also in the Carolinas, issues with Minnesota with mine permits, and Peru basically telling some miners like Hawkshield that they're going to revoke their license to operate. Lastly, another thing that we should look at, and where the Marathon Palladium Copper Project does quite well, is ESG footprint. That's definitely something that companies are looking for in terms of accretive transactions. They are looking at accretive with respect to carbon footprint. All right. Okay. I ran out of time, but basically, so I'm going to skip my summary and conclusions.